I want to give a major shout out to all the folks at Limitless and all the YouTube folks that are out there today and understanding how to use life insurance to complement your real estate. Let's break it down real simple. And I'm going to go slow. When people buy real estate, they buy it for 4 reasons. And this is their goal and outcome. And obviously check with your accountant. I dot T cross everything I'm going to say. But here's the reason why maybe in the past I bought real estate, because I wanted to get 4 spins and or 4 rates of return on my money. Meaning, if I bought property XYZ and I put a down payment on it, I'm going to get a mortgage interest write-off, right? That's 1 rate of return or a spin. The next spin would be whatever the renter's paying versus the mortgage owed is called cash flow. And if there's a positive cash flow, that's another rate of return. The third rate of return is, let's say that I have a job outside of real estate and I'm earning income, right? And in that income, if I buy this piece of real estate, I want to depreciate that real estate on my tax return so I get to lower the amount of money that I'm being taxed on, right? So that's a third rate of return. And last but not least, the fourth rate of return would be over time, no guarantees, I would expect that the property would appreciate in value, even keep up with inflation. So that's 4 rates of return, right? Now, the magical thing about this universe is whenever something new is created, it's based on different components that already exist. So a lot of our investors that are astute, educated, understand risk, and really understand how to leverage their money where they have control and it's liquid and it's accessible, and they love real estate or alternative investments, they'll use life insurance as a complement to that alternative investment. So for example, if I was gonna buy an insurance policy and fund it and build up my cash value while my family's protected from death, disability, lawsuit, inflation, and interest rates, and now all of a sudden, I want to buy an investment piece of property, let's say, I may borrow from the insurance company who uses my cash value as collateral, and keep in mind that cash value is earning a guaranteed rate of return by state law and by contract. And at the same time, there's going to be a dividend that's part of that policy. Certain mutual life insurance companies that have been out there for over 150 years have not missed a dividend payment, and you can check that on your own, Google it and do what you got to do. But if the cash value is earning a guaranteed rate of return and a dividend, right, I'm leveraging that money to buy real estate and I'm getting those 4 spins, that equals 6 rates of return, right? 6. Now, if I buy a piece of real estate off of that life insurance policy's loan and the renter pays back my policy, well, the renter's now paying me interest. So it becomes a powerful savings account, and it mimics, it's not like, it mimics the characteristics of a bank. So now what begins to happen is my renter's paying back my policy, which means I'm paying back myself interest, and even after the loan is paid back, that money is still earning a rate of return on my policy. So anyway, when we do any kind of strategic planning, we want to focus on not the splash, but the ripple, because the ripple as you get closer to the beach gets bigger and bigger and bigger, and within that ripple lies life insurance. It's a Swiss Army knife for overall planning strategies. Have a great day.